I'm going to skate over this fairly rapidly because I think you probably want to hear more about what the panel thinks, because they actually do deals and work on the ground. They know what's going on. So I will probably skate over some of the detail. And I think Richard will probably be sending out the slides later if you want to dwell over them, and do email me if you disagree rampantly with anything I say. But I'm incredibly positive on mainland Europe this year. I think it's set very nicely for actually a very strong year, and some quite interesting things I think are going to happen in the mainland European markets this year. And while my job is mainly about making property sound more complicated than it is, it's really no more complicated than this. Property essentially follows economic growth, and European confidence is pretty strong, as you can see on the left-hand side. This is an overall measure of consumer and business confidence, but consumer confidence across the EU pretty much nearly at record levels. GDP growth, generally quite strong, with the average EU growth over the next 5 years projected at about 1.7% per annum. The smaller countries generally projected to do a lot better. Central and Eastern Europe are continuing to be the China of Europe, delivering very strong GDP growth. But the fundamental, property is all about bums on seats. If you're seeing economic growth, we need more shops, offices and factories. That is the main core story as far as I'm concerned for mainland Europe going forward. Steady, slightly above average growth, many countries seeing better growth than they have in the post-GFC period. In terms of what I think is going to support this growth on top of the economic story, I think China is going to become increasingly important. I think the New Silk Road project, over the next 10 to 20 years, and even somewhat sooner, will deliver a lot of infrastructure growth, particularly in Central and Eastern Europe. Consumer spending, I've already mentioned, remaining quite strong. So while there are quite a lot of people who are bearish on retail out there, I think European retail in quite a good place against the sort of structural change of internet shopping. But most importantly, really, we're now past that moment of excessive austerity. So most of the big European countries coming towards a laxer fiscal and monetary situation, which I think will deliver both business and consumer growth. Downside risks in a use that has been a much longer list over the last 5 or 6 years. Brexit, yes, it's a concern in Britain. Maybe we slightly overplayed the risks of Brexit last year. I think it's going to have a negligible impact on most European countries. That's probably the way it should be. We shouldn't really negatively affect mainland Europe by the frankly stupid decision that we've made. But certainly I think it's better for mainland Europe than the UK. Interest rates coming up undeniably. They will come up across the world over the next 5, 6, 7 years. Generally, my rule of thumb on interest rates and property yields is as long as rents are flat or rising interest rates have relatively little impact on property yields. So I don't see much happening there. Maybe we'll see a little bit of money coming out of real estate back into the sovereign bond market once those sovereign bond yields get to a slightly more exciting level. But all pretty positive, and we saw that in European investment volumes last year, which were up just under 10% year on year, taking us back to roughly where we were in 2015, which was the best year in terms of our records for volume. So lots of people buying it. Where did they put their money? No real surprises there. It was the big European markets that continued to take the lion's share of that, so France, Germany, and perhaps somewhat surprisingly the UK. But as you can see in the bar chart on the left, more countries saw an increase in investment activity than a decrease, and that's a pretty good story, and I think that is going to remain the story in 2018. So touching on the main theme of today, which is about cross-border, certainly cross-border ticked up a bit as the proportion of the total last year. Figures on the left, I think, from RCA, figures on the right from our own data. And I think if you take the whole of Europe and fold the UK into it, you can make a big story about Chinese investment, particularly from Hong Kong. But actually, when you take the UK out of the European totals, it remained the US US investors who are the most active in cross-border investors into Europe. Chinese investors, Hong Kong private investors, relatively inactive in mainland Europe. And I think one of the challenges for the European real estate markets over the next 4 or 5 years is actually how can they make themselves more attractive to this big new pool of wealth that's evolving in China, because actually Chinese investors, as you can see, relatively inactive in Europe when you strip the UK out. When you drill down into a city level, you can really see the scale of this imbalance. So this is looking at investment, again, thanks to Simon and his team, data from RCA. When you look at investment from outside the region, so stripping away the European cross-border money, you can see the bulk of the Chinese investment in the red there, Asia-Pac, investment in the red there was into London. Most of the other cities across Europe, it was mainly US money, but some astonishing growth stories. If you ever wanted a ludicrously high percentage change number, Helsinki saw a 2,065% increase in cross-border investment, Madrid a 1,257% increase. In both cases, there were a couple of very, very large US deals in those markets. Generally, perhaps one might worry if you see this kind of percentage growth. It's unlikely to be repeated, that kind of growth rate. But generally, the big European cities are becoming increasingly attractive to cross-border investors. And I think that story isn't going to change necessarily. I think going forward, Europe actually offers, a good steady pool of security and stability. And 3 or 4 years ago, we saw the world's real estate investors swing heavily away from an opportunistic investment strategy towards an income-focused strategy. And, Germany in particular, I think, stands out in the sort of global real estate spectrum as a sort of, a pool of safety and security. Germany never very exciting, but actually people quite like boring markets at the moment. Nice steady GDP growth, nice steady rental growth, the top of many global investors' lists. So I think Germany seen as offering security and stability, but actually Europe has the political risks of the last 2 or 3 years, leaving aside the Italian elections. There's not a lot of political risk in Europe this year and next. So I think we're going to tick quite a lot of global investors' boxes in terms of safety, security and stability. I do think we're going to see a bit of challenges from other non-real estate classes as the bond yields come up, but I think the volume of money targeted at real estate is going to remain fairly steady. We can't ignore the cycle, different cities, different countries at different stages of their cycle, and I think more importantly for European investors, there's some quite big structural changes happening in retail, office and industrial across Europe. My general rule of thumb for mainland Europe is look at what happened in the UK last year. It's probably going to happen in the mainstream European market. So in the retail sector, internet shopping, comparatively a small proportion of European retail at the moment. It's going to rise. So I think particularly many European countries are going to have to start dealing with that. That is going to affect the retail property sector. Distribution obviously doing well on the back of that, and in the offices sector we're just seeing the beginnings of workspace as a service, WeWork and their peers pushing into the mainstream European tier 1 cities. So some structural changes there. I think investors are going to have to relearn some of the basics across all 3 main occupational sectors, but the story I think when you go across those sectors looking quite positive. So just to wrap up, I thought I'd give you my top picks for investors in 2018. Offices, they're expensive. I think, tier 1, AAA offices are very expensive across Europe, but the fundamentals, I think, of the demand for office space are looking pretty strong. Employment growth's good. The vacancy rate is still falling, and we think it's going to fall further. A little bit of an increase in development activity across the major European office markets last year, but not enough to really satisfy what we think is going to be the increase in demand. So we think vacancy rates are going to stay low, rents are going to continue to rise. You can see there 2.5% to 5% per annum rental growth over the next 12 months. There are some buts. I think the cost of the AAA stock in particularly the Western and Northern European cities just getting down to levels that I think is going to challenge some investors. Development finance still comparatively limited, and we have got this structural change, this challenge from the serviced office providers. And if you look at what's happened in London over the last few years, we've seen about a 20% fall in the number of lettings of 5,000 square foot and below in London. This same story is going to spread out through Paris, Berlin, Frankfurt. So I think the big serviced office providers are really going to start challenging some of the big traditional landlords. I think we're going to see more investors pushing into some of the sub-markets, whether you call it future core, whether you call it the fringe. The chart on the right shows the investment turnover last year compared to the long-term average in some of these edge of core type locations. Investors clearly starting to push into some of the non-core locations, looking for a little bit more yield, a little bit more rental growth. But I think also recognising that occupiers more interested in perhaps some of the more interesting, less corporate sub-markets that have traditionally been the sort of the core CBD in these big cities. So my pick in offices in the bold at the bottom is this sort of edge and future core locations in the big tier 1 cities, tech and media friendly buildings, funky refurbs, turning secondary into prime. I think they will all deliver above average returns over the next 5 years. Retail, I think, is a very mixed story. I think the opportunities to get it wrong in the retail sector are considerable, but the fact that retail is comparatively unfashionable with many investors makes it worth a second look. Consumer confidence, as I said earlier, very, very strong across Europe. I think the biggest mistake that possibly investors can make in Europe is believing that European shoppers don't do internet shopping. When you push down into Southern Europe, only about 3 or 4% of retail sales are online at the moment, and I've heard quite a few retailers and investors saying, well, this isn't going to change. Spanish shoppers, they just don't like internet shopping. Everyone likes internet shopping. It will change, and I think if you're sort of putting the blinkers on and saying my market will not be affected by this, you're probably going to make the wrong investment decisions. That having been said, there are portions of the retail markets across Europe that are far, far more defensive against internet shopping. I've highlighted retail warehousing, which saw quite decent rental growth last year. I think that's probably the most internet defensive segment of retail. It's big units, it's cheap units. That really suits the retailers in a time of pressure on their margins. It's great for click and collect. It's great for returns. So I think retail warehousing stands out as a potential buy in the retail sector. And I think you've got to ask yourself, what will people be doing? What gets people off their seats, away from their tablets? What kind of retail experience do they want? And I think, just ask yourself one question when you're looking at a retail asset. Does it offer shopper experience? Does it offer shopper convenience? If it doesn't offer either, just don't buy it. I think that's the way retail is polarising. So still some buyers in retail, but if you don't believe a word of that, logistics is obviously the place to be. Rents really starting to rise. Prime retail warehouse rents up 2% last year across Europe, 11% up on 5 years ago. And I think that's going to start to accelerate away. You look at the UK again, those rates are running at 4 to 5% per annum. Investment volumes up very substantially. The interesting thing is the chart on the right. In the UK, logistics yields are now lower than office yields. In mainland Europe, the gap has tightened over the last 12 months, but I think it's going to tighten a lot more. I don't think they're going to come down below office yields, but I think that gap is going to close. So if you're looking for the biggest opportunity in yield hardening or capital value growth over the next 5 years, it's definitely in European logistics. I think the market fundamentals are very strong indeed. With a couple of caveats. Margins are very, very slim in the logistics sector, and little local things like a sudden shortage of staff, you've seen it in the Midlands in the UK, a sudden rise in wage rates for warehouse staff can really hammer logistics operators' margins. So I think logistics operators do have to react to these things. I think medium term, we've got to ask the question about autonomous vehicles. I don't think we're going to be seeing it in terms of the domestic car going autonomous in the next 5 years, but I think in the next 5 years we will see delivery vehicles, both large and small, going autonomous, and that will redraw European distribution maps. The need for big warehouses in the middle of countries is just going to become less and less because the trucks will just keep on rolling. They won't have to stop to give the drivers rest. So one or two structural changes there to be worried about. For me, on the logistics side, I think it's much more about what you might call urban logistics. It's the last mile, it's the warehouses on the edge of the big cities or even within the big cities to satisfy that internet shopping that will do well. Geographically, I think it's the big European logistics locations, Benelux, CEE, where the big shed demand will be strongest going forward. But this is probably my top pick. Then you have the whole sort of the rest, pots of what we used to call alternatives. We probably shouldn't call them alternatives, but as you can see in the chart from the right, again from our RCA, the alternatives are no longer alternatives. This is all about structural plays. This is about aging population. This is about the rise of internet usage leading to demand for more data centers. I don't see this story going away. I think we will see more specialist investors targeting these areas. I think we will see funds being launched just to capitalise on some of these segments. They are not fire and forget type investments. They require a high degree of expertise in their management. So I think this will grow. I think what's interesting is that many of you probably look at the PwC Emerging Trends report every year. What really interested me in this year, the list on the left is the sort of top 10 sectors for investment in Europe going forward, is that offices doesn't really even feature in the top 10. And I think there's a degree of fashion here. Logistics, yes, you probably can get invested in. The majority of those other segments are so small that actually I think liquidity will inhibit investors' ability to get into them. So I think if one rolled the clock forward 3 or 4 years and said what were the biggest sectors in European investment, very few of these segments would appear. It will remain offices and retail and logistics, but we will see more demand coming through for some of these more niche sectors going forward. But I think piling into what's new and what's hot and what's exciting could be a very frustrating exercise for investors going forward. So I think there's nothing wrong with going down to the sort of the more traditional segments in terms of focusing on the core, the safe, the dull. There's nothing wrong with offices, there's nothing wrong with industrial, there's nothing wrong with retail. So I think don't get seduced by rushing into these exciting new sectors. If I was a betting man, I'd say that offices will remain the single largest segment of the European investment market, with a drift to the sort of fringe locations. I think retail increasingly looks like it may be slightly contracyclical, certainly with Europe looking a lot stronger than the UK. And if you don't believe any of that, you need to continue piling into logistics. So that was my very quick overview. I think it's all about engaging with Chinese money in particular. It's all about the changing sort of drivers in the occupational markets, understanding those. But actually, I think mainland Europe in particular is looking at a very strong period over the next couple of years. So thank you very much.